Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand the level of risk in the stock market through our proprietary market risk signals that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Tuesday, May 19th, 2020. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. Today we were down 1.05% on the S&P 500 and closed at 2922.94. What we're looking at here is a 3-day, 3-minute chart of the S&P 500. So each candlestick represents 3 minutes of trading in the S&P 500. And of course, yesterday we had that big gap up on some positive news about a small trial test with regards to a possible vaccine for the coronavirus, and some positive remarks from Fed Chair Powell on his 60-minute interview over the weekend. And then pretty much from there, we've been trading sideways around this 29.55 level, which is why I have this blue line here. And we've been trading sideways plus or minus about 10 to 15 points around that 29.55 level until just after 3 o'clock this afternoon. And then you can see here that we had a pretty steep sell-off into the close, and we went from being slightly positive on the day to being negative 1.05% and closing at the lows of today's session. This next chart that we're looking at is a 20-day, 30-minute chart of the S&P 500. So each candlestick represents 30 minutes of trading. And I've got two lines here. The 2960 line, which is where we kind of peaked out on the 30-minute candles over the last couple of days. You can see where we just could not get any closes above this 2960 level on the S&P 500 on these 30-minute candles over the last couple of days. This 2960 level will now, at least on the 30-minute charts, provide overhead resistance on the S&P 500. And you can see here with the sell-off late in the day today, the question becomes now, are we headed back to this 2800 level, which, predominantly we've been trading between about 2800 on the low end and about 2940, 2950 on the high end for the last month, as we see here. So it would be completely normal for us to pull back to this 2800 level, or will we get lucky and maybe only pull back to, 2900 or 2850 on the S&P 500? It's anybody's guess at this point, but we should not rule out a pullback to at least 2,800 on the S&P 500 over the next few days or even into next week. If it doesn't happen by the end of this week, it could easily happen sometime next week. The next chart that we're looking at is a 6-month chart of the S&P 500 where each candlestick represents 1 day of trading. The two lines that you see here, the horizontal lines, are the 200-day moving average, which is the orange line, and the green line is the 400-day moving average. Let's start off with the 200-day moving average. Now, first off, you can see that this is kind of a downward sloping 200-day moving average. That is bearish. The 200 should at least have a slight incline to it in a normal market like we had coming into the first part of 2020. And when you see a downward sloping 200-day moving average, that in and of itself is a bearish sign. The 400-day moving average is also slightly downward sloping, as you see here. And, of course, we have not been able to close above the 200-day moving average since the early part of March. And the other thing to point out here is that we've only had 6 closes above the 400-day moving average since March 6th. So we've had 1, 2, so right here, 1, 2, 3, 4, 5, 6. So today was the 6th day that we've closed above the 400-day moving average since March 6th. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. So the takeaway from today's session is that there is still a tremendous amount of risk and uncertainty in these markets. So please don't become too complacent. If you have made some profits over the last week or so, you might want to keep your stops short. You might want to rebalance portfolios, take some profits here, because it does look like we're starting to roll over here and lose some momentum. And again, the last couple of sessions, this was the first time since the early part of March that we had 3 positive days in a row. So it may not be a bad idea to take some of these profits that you made over the last few days, at least capture a little bit of those, because it looks like we might be starting to roll over here. And be careful, guys, because we're still underneath this 200-day moving average. And most sectors, when you look inside of the S&P 500, most sectors of the S&P 500 are still very weak. Please remember to subscribe to this channel, give me a thumbs up on this video, and if you are a financial advisor or an individual investor who manages any of your own money, including in your 401k, your 403b, your IRAs, or of course your trading account, I would encourage you to take a serious look at Simple Market Signals, which is my personal risk management model that I have now made available to the public. For those of you who would like to learn more about how Simple Market Signals can help you in both up and down markets, here's some additional information. As part of the Simple Market Signals model, there are 2 powerful indicators. There's a risk-based indicator and a trend indicator. As a subscriber to Simple Market Signals, you will receive information on what the risk level is in the overall stock market, as well as what the trend direction is in the overall stock market. So this really, really helps. The way we disseminate the signals to our subscribers is via our weekly emailed newsletter. So within the newsletter, every weekend, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the early bird indicator, the trend direction signal on the overall U.S. stock market. You will have market and sector performance information on multiple time frames. You'll get market commentary and a weekly recap of what happened in the market. You'll have technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information in this newsletter every weekend. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There's no contracts. You can cancel anytime, and your first 2 weeks are free. Now let's recap what you get with your subscription to Simple Market Signals. You get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there is a major signal change or direction change, we're not going to wait until the weekend to get that information to you. We will send out a special midweek update when necessary to keep you up to date as to what's going on within the model. And the best fit for a subscriber for Simple Market Signals is somebody that has at least a 6 to 8 week time frame or longer. So if you're a long-term investor, you're going to love this. If you have at least a 6 to 8 week time frame that you focus on with your trading and investing, you're going to love this. If you're an ultra short-term 1 or 2 day trader, kind of a day trader, or somebody that trades within a week, Simple Market Signals might help you a little bit. But the reality is, the people that are going to benefit the most from a subscription to Simple Market Signals are those people that have at least a 6 to 8 week plus time frame that they're focusing on. And if you want even more information on Simple Market Signals and some of the strategies that you can use on the various signals, this is a very in-depth video that I will have linked in the description box below this video, along with a bunch of other videos that you may want to explore if you need additional information on Simple Market Signals before you subscribe. Also, keep in mind that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. And to subscribe to Simple Market Signals, all you have to do is go out to the website that you see here, https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that simple.